Malaysian bonds have outperformed Malaysian equities in 2019. Will we see the same in 2020? What were the key issues plaguing investors last year? Will we see brighter days ahead? Hello, I'm Doreen Choo from eastspring Investments, and this is our market outlook for 2020. So what is the story for 2020? The story rests on three key questions. Will there be a trade deal? Will global growth stabilise and set the stage for a cyclical recovery? Or will the US finally enter recession in 2020? Are there any domestic catalysts in sight? Weak global growth is partly trade-induced and has affected the manufacturing sector. Services, though, continues to expand, although at a slower pace. We expect this trend to continue as long as the trade war weighs on global trade. But we do not expect a recession in the US, as US consumption, which makes up more than 60% of the US economy, is still resilient. The IMF and World Bank have cut their global GDP forecast for 2019, but both still project a higher growth for 2020. And we also note that the US yield curve has not stayed meaningfully inverted. In fact, there may be an investment recovery in the second half of 2020 from the structural supply chain relocation trend out of China. We also see signs of inventory digestion in North Asia. Could this set the stage for a pickup in industrial production in 2020? Historically, this has been a good signal of cyclicals being close to the inflection point. In short, global slowdown is well telegraphed. Investors have de-risked and are already defensively positioned. Therefore, the key call here is whether there is stabilization and/or re-acceleration of global growth in 2020. But if global growth continues to slow, what tools do we have to face the slower growth? Most countries will employ a two-pronged strategy, cutting rates and boosting fiscal spending. In Malaysia, Bank Negara stands ready to act. This will be supplemented by our mildly expansionary budget 2020, where the government has relaxed the fiscal deficit target for 2020 to 3.2% from the original 3%. So overall, we believe Malaysia's GDP will stay resilient, inflation will remain benign, the current account will remain in surplus, and employment as well as consumption will remain strong.